You have seen the ads, a laptop on a beach, a smiling face. 90% of day traders lose money. Not some of them, not most of them. 9 out of every 10 people who attempt this end up with less than they started. I am a trader myself, and there was a time I could not win because of psychology. It took me 3 years to understand this. Was it my strategy? The market? The timing? No, it was all on me. My own thinking, my own psychology. This video is not about how to trade better. It is about why most people cannot. No matter how hard they try, no matter how many courses they buy, no matter how clean their chart setups look. Let us start with the actual numbers. A study of Taiwanese day traders spanning nearly 15 years tracked every trade in the market. Fewer than 1% of active traders consistently earned money after transaction costs. Not 1% of beginners. 1% of all active participants, including those with years of experience. A separate study tracked roughly 80,000 brokerage accounts over 6 years. About 3/4 of those accounts lost money in every single year of the study. The longer someone traded, the worse their results tended to get. FINRA, the regulatory body overseeing US brokers, reports that most retail trading accounts show losses within the first 12 months. These patterns hold across decades. They hold across different countries. They hold in bull markets and in bear markets alike. This is not a warning from people who want you to give up. It is a pattern documented in peer-reviewed research for more than 20 years. I have had the chance to support individual investors, to watch them trade in real time. Doctors, accountants, engineers, highly educated professionals. Most of them still struggled. Trading success has almost no relationship with formal intelligence. I have confirmed this over and over. Before your first trade, you are already losing. Every trade has a cost. Even platforms that advertise zero commissions make money on the bid-ask spread. When you buy, you pay slightly more than the quoted price. When you sell, you receive slightly less. For large institutions, this gap is almost nothing. For individual retail traders, it adds up fast. A trader making 10 trades per day, 5 days per week, pays out roughly 15 to 20% of their account in friction costs over a full year. That is before any gains or losses from actual market movement. That means you need to outperform the broader market by that full amount just to break even. Most professional fund managers cannot beat the market by more than 2 or 3% per year. The average day trader needs to beat it by roughly 10 times that amount just to keep their account flat. It is like entering a casino where the house edge is not 0.5%, but closer to 15. The math works against you from the moment you start. Most people imagine day trading as reading charts faster and smarter than other individuals. That is a fundamental misunderstanding of who is on the other side. On the other side of most retail trades are algorithms. Systems that process millions of data points per second. They hold positions for milliseconds. They have physical servers placed inside the exchange building to shave microseconds of execution time. They were built by teams of mathematicians, engineers, and academics who have been running these systems for years. Every pattern a retail trader notices in a chart has already been noticed by those systems. Every signal has already been priced in. Every breakout has already been front-run. When a retail trader clicks buy on a breakout, an algorithm has already taken that position at a better price. It will likely exit before the retail trader even realizes the trade has reversed. This is not conspiracy. This is just who participates in modern markets. You are not reading charts against other people. You are sitting at a table where most players have advantages. You cannot close with effort or discipline alone. Here is where the psychology becomes genuinely dangerous. Most new traders experience a period of early gains. The market is moving upward. Confidence is growing. They start to believe they have found a real edge. This is almost entirely luck. In a rising market, nearly any strategy produces gains. That observation says nothing about a trader's ability to manage risk when conditions reverse. But the brain does not process it that way. Every winning trade creates a small reward signal. The brain starts to associate trading with success. Confidence builds faster than skill. Risk tolerance grows. Then the market shifts. That same psychology now accelerates the losses. This is called overconfidence bias. It is one of the most consistently documented effects in behavioral finance. I know this trap personally. I have taken gambling trades, ignoring every rule I knew. Sometimes it worked, but it never lasted. Refusing to cut losses, holding through unrealized pain. That is not discipline. That is the market slowly taking everything you have. Early gains do not build skill, they build unearned confidence. And that confidence is precisely what makes the eventual losses worse. You have probably never seen a YouTube channel called How I Lost Everything Day Trading. The people who succeed are loud. The people who fail go quiet. They delete their accounts. They stop posting. They leave the forums and never come back. What you see online is a curated selection of the small fraction who made it. Your brain observes these stories and draws the wrong conclusion. You think they are representative of what is possible. They are not. They are the exception. And you see them precisely because they survived. This is survivorship bias. Every visible success story is built on a foundation of invisible failures. The forums look full of successful traders because the unsuccessful ones already left. When you use visible winners as your baseline, you are measuring yourself against a filtered sample. It excludes the majority outcome, which is quiet, invisible failure. The human brain is one of the most powerful pattern detection systems in nature. For most of human history, that was a survival advantage. In financial markets, it becomes a liability. Markets are partially random. Price movements contain real signals, but also enormous amounts of noise. A random number generator, plotted over time, produces shapes that look exactly like head and shoulders formations, support levels, and trend lines. When traders see these shapes in actual price data, the brain assigns meaning to them. Strategies are built around patterns that have no forward-looking value. Those strategies are backtested and found to work because given enough variables, any set of rules can be fitted to historical data. That is not discovery. That is overfitting. The same cognitive system that helped our ancestors detect predators in tall grass is now scanning candlestick charts for signals. A predator either confirms or denies the pattern immediately. A market can go sideways for months, punishing and rewarding the same behavior in ways that reinforce false beliefs long before they break down. I am going to tell you something personal. Unplanned averaging down in this market leads to ruin. I know this firsthand, stacking positions endlessly against the trend. What traders call infinite averaging down, fighting fundamentals, fighting major price action. These are the biggest mistakes you can make. I once lost the equivalent of roughly $270,000 through this exact pattern. It was the most painful experience of my trading career, but that loss changed everything. It forced me to become a different kind of trader, one who follows the rules without exception, one who cuts losses fast, one who removes emotion and removes gambling completely. The loss did not teach me a better strategy. It told me that strategy was never the real problem. My psychology was, here is what I follow now. None of these are complicated. The hard part is following them, every single time. Rule 1. Always set a stop loss. Risk no more than 2% per trade. One trade should never be able to destroy your account. Rule 2. Wait for the full setup. Never enter early because a trade looks good. Patience is not optional. It is the edge. Rule 3. Once you are in a position, stop watching the chart. Stop checking the P and L. You made your decision, trust it. Rule 4. Losing streaks do not shake me. Winning streaks do not make me arrogant. Variance is not information. Treat each trade the same. Rule 5. Only take high probability setups, the ones backtesting confirms. If the setup is not there, there is no trade. Walk away. 1 loss, 2%. 10 losses, 20%. Painful, but survivable. The traders who blow up their accounts are not unlucky. They are unstructured, Structure is the only real edge a retail trader can build. Profitable trading does exist, but the people who do it consistently look almost nothing like the retail trader. Institutional traders operate within structures. Risk limits are set by someone else and enforced externally. Research teams provide context. Compliance oversight builds in the discipline that individuals lose under pressure. There is also a selection process. The traders who reach institutional desks have been evaluated across hundreds of hours of simulated trading. Many do not make the cut. The ones who remain are extreme outliers. The retail trader operates alone. They set their own risk limits and override them when a trade looks compelling. They manage their own emotional state under pressure. Any significant loss activates panic decision-making, and panic leads directly to larger losses. The gap between institutional and retail outcomes is not mainly data or technology, it is structure. The structure removes the psychological variables, and the psychological variables, it turns out, are where most of the damage happens. None of this means that markets cannot build wealth. The data on long-term, low-cost passive investing is some of the clearest evidence in personal finance. A broad market index fund held for 2 decades has outperformed roughly 90% of actively managed funds. The path to building wealth through markets is not more trading, it is less. It is removing as many of your own decisions from the equation as possible, lowering costs, broadening exposure, extending your time horizon. The day traders who fail are not failing because they lack intelligence. They are failing because they are human. The market is a system refined over decades to extract money from human behavioral tendencies, overconfidence, pattern recognition, loss aversion, survivorship bias. Each one a feature of human cognition that works brilliantly in most of life and fails systematically in markets. Understanding these mechanisms is the first line of defense, not a new strategy, not a better indicator, an honest understanding of what you are actually doing when you open a trade. The specific biases, overconfidence, loss aversion, the sunk cost trap, each deserve their own breakdown. We are covering all of them in this series. If this changed the way you think about trading, subscribe. Every week we run the numbers most channels will not show you. Next, the psychology behind revenge trading. Stay with us.